Welcome everybody to this short video tutorial on interest rate risk management. Today we're going to be speaking about various ways of managing your risk that you have with potential floating rate bonds or actually with the refinancing of future bonds. And we'll first go through the environment that we're actually in today, and from there we'll look at the annual report of CocaCola, and from there we'll actually define the potential problems that may arise and look at certain solutions. So, first of all, the current landscape. We are in a very interesting landscape. The Federal Reserve has just hiked interest rates by 25 basis points last December, and interesting enough, we did not see much movement on the whole interest rate curve. Obviously, this was already pre-calculated. People were expecting a hike in December. So now the big question is, what will happen in the future? In 2016, it's expected to have around 2 to 3 interest rate hikes on the front end. But more importantly, what will be actually the impact on the back end of the curve? Historically, we've seen that interest rates fluctuate quite a fair bit. And we've seen them as high as 8% in 1990, and since around 1995, it's been somewhere between 2 to 6%. So the question now really is, moving forward to 2017, 18, 19, and 2020, where do we actually see interest rates? And what can that have an impact have, let's say, on future refinancings and actually on the calculation of interest for firms? Now, not only on the front end of the curve are we interested to see how the movements are, but it's also on the back end of the curve, the whole curve actually. Here we can see a historical overview of the US Treasuries, starting from the 1-year rates, as you'll see at the top left corner, all the way down to the 30-year rate. And interesting, you would say that they're quite correlated. We can see the same trend. We saw that we had a hyperinflation environment in the 1980s. And then from there, we've had actually a downward trend of interest rates. Now, interesting enough, they're not as correlated as most people would expect. And this is typically the challenging question that most firms have, is that if we do have floating rate debt, when is actually a good time to potentially fix it or refinance? Just looking more closely at the movements we've seen over those since 1995, here the 1 year again at the top left-hand side, and to the right-hand side at the bottom, we can see the US 10-year rate. As you'll see, the 10 years is absolutely decorrelated from the 1 year in terms of movements. It's much more correlated to the 5 years and the 7 years. In terms of capturing this information in a correlation overview that we see here, we can see that in 2010 and 2011, rates were highly correlated. And this is what most people expect. And this is what a lot actually of these calculations are on the back of exotic interest rate derivatives. However, as we move to 2012, we see that the short end of the curve was decorrelated to the back end. Again, nothing surprising, but as we slowly move forward and we see 2014, that's something that was kind of a shock. Here we can see that the back end of the curve is correlated to each other, so the 30 years and the 20 years and the 10 years, but was completely decorrelated from the front end of the curve. And through these colors, this becomes very clear. And this is sometimes a movement that is not always expected in the markets, and one that is very challenging for corporate treasurers. The question always is, if we do a refinancing, if we're going to fix our debt from floating to fixed, where do we actually, which point do we take? Do we potentially refinance for the next 10 years? Or do we maybe only refinance for 5 years and then in 5 years' time refinance again? Now, looking at the Fed and that they've increased rates by 25 basis points, the question really is, how will the whole curve from here move forward? And what are the expectations? Now, before we answer that question, when we actually look into what the impact is, let's have a quick look at Coca-Cola, a well-known household name, and a company that certainly does also use derivatives for the management of their interest rate risk. Here's a small excerpt from the annual report. So the company is subject to interest rate volatility with regard to existing and future issuances of debt. Now, as you can see in the second base part, you can see based on the company's variable rate debt and derivative instruments outstanding as of December 31st, 2014, a 1% point increase in interest rates which had increased interest expense by 150 million in 2014. So here we can see that they clearly do have a risk for a rising rate environment. Now, they are saying that, however, this increase in interest expense would have partially been offset by the increase in interest income related to higher interest rates. Question, of course, there is, what is the maturity of their debt and what is the maturity then of their investments? And what kind of spread risk do they run on the curve? Moving forward, this is an overview of Coca-Cola looking at their outstanding debts. And here you can see the bigger the circle, the more the debt. Most of their debt will actually have to be refinanced in the next 5 to 7 years. There's only a small part that actually goes beyond 20 years. Now, a lot of this will be obviously subject to rates in the future. We can see there's a large part being refinanced in 2024, 2026, and 2027. And the question there is, will rates be back at 2.5 or 3%, or will they actually be at 5 or 6%? Because if you'll be refinancing this debt at 6%, then potentially that has an impact on your stock price. So, what are the two questions that most corporate treasurers will face? One, should they actually be converting their floating rate loans or bonds to fixed at the moment, given that we potentially are sitting in an increasing rate environment? And how should it actually work with the refinancing risk? Now, in order to look at these answers, we have to look at the instruments that are available. Today, we'll focus on derivative instruments. Here we can see 4 common instruments. One is the interest rate swap. The second one is the interest rate swaption. The third one is interest rate cap. And the fourth one, we can see we've got digital caps, and which is actually similar to a cap spread. The interest rate swap here, we basically swap from floating to fixed, from fixed to floating. These are the widely used instruments. They're these days exchange traded, and everybody has access to these swaps. Now, what we have seen in the past is that a lot of the endowment funds of universities were actually anticipating refinancing risk, or even the risk they had with future projects. And they were scared of an environment where rates would be much higher. Knowing that the project would start in 5 years or 3 years' time, what they did is actually entered into swaps. One part actually that they might not have taken into consideration is that the project might not go through. Unfortunately, during the global financial crisis, a lot of their projects, basically building new campuses and part of the campuses or gyms, fell through and were not done. Therefore, they did not require the debt, and therefore actually did not require the swap. And that was a major problem, because at that time, those swaps were deeply negative, had a deeply negative mark to market. And that meant they had to unwind the swaps and pay the banks a lot of money. So one of the ways to actually counter that, or would have been a better solution, was to focus on an interest rate swaption. Therefore, you have the right to enter into the swap, but you actually don't have to. You will lose your premium, obviously, for paying for a swaption like that. Alternatively, people can look at caps and spreads. Now, the biggest challenge is often, how do I choose between these 4 instruments? And a lot of people look at their expectations of rates. But as we all know, it's very hard to determine exactly where we think rates will be. Typically, we have an idea, we have an expectation. Basically, we assign a probability that it's a 60% chance that rates will be higher, and there's maybe a 20% chance that rates will remain where they are, and there's maybe a 20% chance that rates will go down. But nobody actually uses these probabilities to then actually decide between the different instruments they can use for hedging. And ultimately, that's our tip for today. If you're going to make a decision in terms of which instrument to use for hedging your interest rate risk, then the first step actually should be, one, what is the risk of potentially not refinancing or maybe actually buying back your debts? Do we then use these instruments? And the second question then is, if so, if we perceive to have a high probability of moving forward, what are then actually the right instruments to use? And here again, another probability analysis can be used. Here you assign a certain probability for the different ranges of where you expect rates to be. It can be the case that you say, I assign a 5% probability to rates being beyond 8%. That's what we've seen back in the 1990s. You assign maybe a probability of 20% of rates being at around 6%. And then you assign a new probability to where rates would be at 4%, etc., etc. Using this, and then the outcome basically on the cost of your interest rate risk management gives you a much better picture of what will ultimately be the best solution for your firm. So that was actually our video tutorial for today and our main giveaway for today, and I hope to see you soon. Thank you.